Let's move to the issue of equities. You're looking here at a chart that Robert Shiller does constantly about the price-earnings ratios of U.S. companies on a trailing 10-year basis. And currently it's at 25. Historically, it has been 17. So stocks are not by any reasonable standard inexpensive. One of the things we've been doing for a lot of years is something called covered call writing, where we buy companies we really like that are paying usually good dividends and growing, and we write options on them to generate additional income. What that does for us is it reduces the risk of investing just long only in stocks. It increases the cash flow through the premiums that we get because somebody's paying us for the right to buy the stocks in our portfolio. So we reduce our upside potential, but we also reduce our downside risk. And all the income that we get from writing these calls is taxed as capital gains, or half the rate they would be if they were interest. Now, if we take a look at a comparison, this comparison goes back to December 2007. So I'm looking at one big bear market and one big bull market. So I'm covering one cycle here, and we're comparing our covered writing pool to the TSX total return. In the 6 years involved here, the covered writing pool has generated 2.5 times the return with 40% less risk or less volatility in the portfolio. So as we go forward, we continue to see this as a useful strategy to de-risk the positioning in equities. Let's look at some other asset classes: real estate, infrastructure, timberlands, and agriland. First off, one of the things around institutional investing, David mentioned about the Canada Pension Plan, but most institutions have been dramatically increasing their allocation. They've gone from 3 to 20% over the last 30 years in these alternative and real asset classes, and reduced fixed income from 55 to 25%. And in fact, if you measure risk, real assets have similar returns to equities over a long period of time, but with about 1/3 the volatility. Now, to be fair, part of the reason for the lack of volatility in many of the real hard asset classes like infrastructure and real estate is because basically they're not liquid. So people can't essentially get in a panic, as we saw in 2008, 2007, 8, and the early part of 2009. So a good example of this is that you can buy real estate by buying the actual real estate or through real estate partnerships, and you can buy real estate in Canada through real estate income trusts, which trade on the stock market. So if you measured the returns of REITs, the publicly traded real estate in Canada, from 2007, roughly in the fall, to the spring of 2009, over 18 months, the actual price of REITs, on average, the average REIT dropped 70% in value over a period of 18 months. The actual price of real estate that was changing hands dropped 10%. So in theory, rational buyers and sellers understood what was going on in the real estate market, and yes, they weren't willing to pay as much as before, but they weren't willing to sell for more than a 10% haircut. But people were willing to take a 70% haircut because they get emotional, and they can, in publicly traded environments. This goes back to the issue of what David talked about with the Dalbar study. Private equity, 1/3 of the equity position that the Canada Pension Plan holds is private equity, not public equity. And if we take a look at these categories, they all get a very high percentage of their return from cash flow. So we'll look at one in particular. This is a kind of a busy graph, but this is an IPD chart. This is a company that specializes in measuring real estate prices for big institutions all over the world. This chart is for Canada for the last roughly 30 years. And what it's showing here is that the worst year in the last 30 years for real estate, total return was -6.4, and best year was 18. But in every single year, that green bar is the income, the rental income on the assets. It's always positive. There's always cash flow. Now, when we compare this to the stock market, this is the TSX, so it's the same country. The range of returns in Canada, highest to lowest, go from -35 to +33 compared to the real estate. So when we look at the two and compare them, first off, the returns are the same for both over 30 years. So it's important for you to realize when we say we like real estate, we do not like real estate as a superior performing asset to equities. we're very comfortable over the long run, they should perform more or less the same. But they don't perform more or less the same way. So the IPD range of returns was 25%. The TSX range of returns was 68%. So there's always going to be more volatility in publicly traded markets. And 70% of the return for the real estate comes from rental income, whereas only 30% of the return for stocks comes from dividend income. So there's a higher reliance on cash flow. Nevertheless, real estate is going to be impacted in some way, shape, or form with long-term higher interest rates. So this is a graph of what's called a cap rate versus a bond rates roughly for the last 35 years. If you're not sure what a cap rate is, a cap rate stands for capitalization rate. It's really what is the yield on a building I buy if I owned it 100% with no mortgage and I paid all my expenses. What is the net income or yield that I would get on the property? So if I get a 6% cap rate, I own a $10 million building, I would make $600,000 a year of income. So that's what we're looking at is the cash flow from the building. And the cap rates, roughly 20 in the late 80s, early 90s, was roughly 6.5% to 7%, but mortgage rates were around 10%. Today, mortgage rates are 4%, cap rates are between 5.5% and 6.5%. So what's happened in the last roughly 25 years is cap rates have dropped about 1% to 1.5%, but mortgage rates have dropped over 6%. So while there's a correlation between lower or higher interest rates and cap rates, it's not uniform. And it works both ways, whether rates are rising or falling. So what we wanted to do is take a look, because we're always buying real estate assets, how would real estate assets perform if the environment for them changed, if we had to pay a lot more for mortgage rates, for example. So we took a look at a $25 million building with a 6% income. That would be approximately what we would expect to see today. Financing it at 6%, 60% at 4% for 10 years, locking in the mortgage rate with a 25-year amortization, and assume rents more or less rise with the very modest inflation we have now, 2% a year or maybe a bit less. Now what happens in 10 years' time if mortgage rates are now 7%, the cap rates go up as a result of that, inflation rises to 3% annually. We're looking to build a model to say, what should we expect to see as a rate of return on this asset? So, after 10 years, here's what the building would look like. The rents would have gone from $1.5 million to about $1.8 million a year, so they would have risen slowly over time as a result of inflation. We would have paid $4 million off the mortgage, so we would have reduced our exposure to debt. The net cash flow in the building would have risen by 50%. So all of those are good news things. Now, when we take a look at what the building's worth, now this goes back to the Buffett issue of focusing on price at the expense of cash flow. The building started here at $25 million. It would be worth $31 million if nothing changed, but as the cap rates go up, the value of the building drops, and in fact, it would be below our starting position at an 8% cap rate. The building would drop in value, but our equity would have gone up because we've paid off a decent chunk of the mortgage. The returns would go anywhere from a very healthy 10% after expenses to a pretty modest 5.6% after expenses at an 8% cap rate. But we would own a building with 50% more cash flow. So how you look at this glass half full, glass half empty is an interesting issue because it depends what your objective is. Our objective is to try to increase the net cash flow from all the real estate that we manage on our clients' behalf. And that's our focal point. So the observations here are higher cap rates and higher interest rates are likely to occur at some point in time. They would typically, we expect to be accommodated by or accompanied by higher inflation and higher rents. And that long-term return on the asset depends on what those net rents are. So in terms of where we ideally would add value, there's 6 areas. Can we be better at the way we lease a building? Can we reduce the vacancy within the building? Can we manage our CapEx, the money that we're going to spend to upgrade the building, well? Can we make sure that we've locked in our finance and staggered the maturity dates on that financing? Can we make sure that we buy assets that are not trading in a bidding war, that we buy them off market? And most of the assets we now acquire are in that category. And are we prepared to sell assets because they've reached, in our opinion, the maximum value that we're likely to see? And we're comfortable in making those decisions. So going back to Jeremy Grantham's graph of sort of depressing assets in the future, we think that looking at covered writing, at mortgage portfolios and rental income and alternative asset classes like private equity and farmland are all solid alternatives to continuing to maintain a good real rate of return. Now there's a bit of an outlier here that I wanted to talk about briefly. It was mentioned last year, we've written some articles about this, about shale oil and gas as a game changer, in particular for the US, and ultimately, we hope, for Canada as well. So, an update on this. This is articles from The Economist, and one of the things it's pointing out is gas is going to be the significant, not only is it the fossil fuel of the future, but is a significant part of the energy production in the US, the energy growth. Oil is increasing, oil production is increasing in the US, but not as fast as gas production is increasing. Right now, the US has overtaken Russia on oil production and is close to Saudi Arabia and has just overtaken Russia on natural gas production. In fact, the IEA says that the US will be the top oil producer in the world by 2015. Now, if we take a look at the price of gas is very volatile. This is the price of gas in North America. It's been slowly recovering for the last roughly 6 or 8 months, partially because of a pretty cold winter. But when we look around the world, North American gas at the end of last year was roughly $3 a 1,000 cubic feet. The rest of the world, it's way more expensive. So the problem North America has is they can't get the gas off the continent. So the US is now no longer importing gas. It can export gas as long as it can figure out a way to make LNG work. But in the meantime, it depresses North American prices artificially against world prices. So with those LNG plants, you could not only reduce the US trade deficit even more than has been the case, but you would get a significant increase in gas prices in North America. Still less than it would be in the rest of the world, but it would be a noticeable change, which is why we're quite positive about investing in natural gas as a long-term strategy. And the other thing, of course, that's occurred most recently is the issues in Europe with respect to Russia are going to make, I think, a lot of European countries look for alternative sources to gas outside of Russia. And that could accelerate LNG developments in both Canada and in the US.